A very good morning, traders. It's Steven Upon here, founder of Master the Markets, Illustrates Conference, and Traders Open Day. So today we are on the morning glory strategy, okay, and we're looking at cable on this particular day. We have taken already two positions on this particular trade. As you can see over here on our account history, you can see that we have taken the first position at a small loss, and the second position was a hedge position that actually made very minimal profit, almost near the break even, but has minimized the loss as well. So what have we done? What we done today is what we call a hedging a position. What we call hedging a position. So when would you actually hedge a position? So let me go through with you what really actually happened today and explain what was the thought process behind it and why did we hedge this position and how, and what you can do also to learn from us in terms of hedging your own trading positions. So now let's take a look at this at the moment. So this is what we had as of at 8 a.m., the 7 a.m. 1 hour bar as we call it. And according to that, what we had over here was actually a lower time frame bias to the upside. And the second thing we had was the higher time frame bias though was to the downside, okay, was to the downside. So now based on that, since we have the first point which is required for a hedging position is that both the time frames must be mismatched, okay, if you are looking to take a hedge position in the first place. If you have both the time frames aligned to the upside, we won't take another position opposite to our first current position, okay. So that's the first prerequisite, so for a mismatch to happen between the two time frames. The second criteria that we look for is we take a cue from the lower time frame. So we study the price action from the lower time frame and we see if it's giving us a signal of towards a long side and is giving momentum. In this case we did have that, so we did put a position on for the upside to go long and a stop loss at the bottom of that setup. So that's what we did next, okay. So we took a cue from the lower time frame, all right, to enter our positions, all right, and to trail our stop loss. So that's what we do based on that. Now the third thing that we do, so just a little bit elaboration on the second point, is that since you're taking the cue from a lower time frame, therefore our entry or our stop loss or even validating the trade can be negated from the lower time frame data price points, all right. So that's what we can do. So that's what we mean by taking the cue from lower time frame. So if it's done A, B, and C already before I can enter the trade, then I would not even place a trade on the lower time frame, even though it's a mismatch. Understand? The third thing then we do is once we are in the trade on one position, which is the long in this case scenario, then what then happens is, as we move forward, as you can see, that trigger does in, but it was reversing. At this point, we have a validation for a short entry as well. So now this is where we are saying take the key from the lower time frame, and not only that, this is where we will start to place an order to the opposite side. So now we got two orders. Now in the market. One has already been triggered long, one is already live, and the other one is pending. Order, isn't it? But in the next 1 hour, what happened is, in the next 1 hour, as you can see, there was a big massive seller bar, which then took us all the way in, okay, and at that particular moment, now you have two orders, one long, one short. But however, in this example, by this time, as the hour finished, the first order that we had taken had been cancelled out. So we're only on the second position right now on the short. So we've taken a first loss already, and the second position is now running. Now, then the third point which I come to, once you have one running already, but then you have a scenario like this, where now is aggressively moving to the upside, what do you do? So when we observe that and we know that today is a mismatch and it will be quite a bit messy move. So what we do, the third thing, is we do an aggressive cover. We do an aggressive cover. That's what we do, okay? So to minimize our loss. Because you see, traders, remember that we're taking two positions today. So when we're taking two positions, what we do not want is both highly probably, highly possibly, as much as you can, you do not want the two positions to go into negative losses, because what would then do, it would then give you a big loss, which is very highly denting to your equity curve, and then it's very hard then to pull it up to positive territory, okay? So therefore, we're very cautious of that, and that is why we did a very aggressive cover in terms of the second position, and we came out with a very small profit, which actually reduces the loss from the first position as well, and doesn't add up to the loss, which is more important. All right, so that's what we exactly did. But you got to be also strategically right. Just because you want to minimize your loss, you can't go and aggressively cover anywhere. It has got to be a technically validated point. Okay, that's what you have to do. But in cases like a mismatch, you have to be very, very cautious, and to not to really, mainly your whole thing is not to take a big loss, especially on two positions. All right. So these are the three things you need to consider when you're hedging a position, and that will help you put you in a very strong position in your trade management. Okay, so that's what we are seeing over here in terms of a transparent track records over here. In terms of the losses, minus 290 and a plus 781, very, very small loss today, and we took it all at 1/3 of our usual position sizing because it was not matching as one of our normal trades. And you can see the very strong reversal point happening at the moment in the market. Okay, all right, so that's pretty much that from me in this video. I believe that you'll be going and reflecting on this and seeing how, if your strategy also involves hedging, how we can incorporate this so that you can also then optimize your strategy. Okay, and we do all this actually in person. Sometimes people love it when they see us doing all this. We do it actually at live trading boot camps as well. We show all this in live, massive learning points along with the strategies that we teach as well. Of course, if you got any questions, anything, you can always email us and ask us more queries. Alright, as we always say, till the next time, stay disciplined, follow your trading plan, and keep trading like a master.